Hey, it's Joe again. We've been talking a lot about how to analyze deals. We've been talking about specific deals and specific questions that I've gotten from you guys. And what I thought might make a little more sense than going into more deals that are sent to me specifically from you guys, because I got so many of them, and I appreciate you sending them. But I think that what might make more sense for you is to let me go through a series of videos that show you what does make sense. Rather than saying, does this make sense? Let's show what does make sense, what is possible. And then you can extrapolate from there. Does my deal fit into what makes sense? And why do these make sense? So these next videos that I'm going to show you are going to be the different types of deals that you can make money on. And remember, it always goes back to those two things that I tell you about all the time. There's only two ways, two types of deals that are going to make you money. One is properties that you can buy dramatically under market value for cash or assignable, or properties that you can buy at market value or below, but you can buy them on terms. Either one of those ways, you can almost always make money as an investor. And you can do it in different ways. So let's start, though, with cash deals, properties that you can buy dramatically under market value. And dramatically under market value is one of those variable sort of numbers. 5 years ago, 20% under market value was considered dramatically under market value, especially in some markets that were shooting up, 40, 50% a year in value. If you could buy something 20% under market value currently and knew that it was going to go up another 50% that following year because the market was going so crazy, that could be a pretty interesting deal. And by the way, that's how I started in real estate investing. I bought a property that actually I bought it at market value. It was being built. It took them 4 months to build it. By the time it was built, it had gone up 20% in value. And I remember thinking, wow, this is cool. And that was in 1986 when the market was going crazy. And don't do that, by the way. Don't buy properties based on appreciation. That was a stupid thing to do. I was just lucky. I got in at the right time, at the right place, and I didn't lose money. I started making money immediately. A lot of your first experience in real estate investing is where you lose money, and that's a shame because it usually knocks you out of the game, and it keeps you from doing it again. I was lucky. I got a taste of it, and I started thinking, well, what if I actually bought the property under market value? What a light bulb that was. So I started buying properties from HUD and from VA foreclosures, and I'd fix them up, and then we'd turn around and sell them. Plus, I had the appreciation that was going on in the market naturally at that time, and I was able to buy properties at 15, 20% under market value, and that would be considered dramatically under market value at that time. Right now, in this market environment, 20% under market value is not dramatic. You're seeing properties all the time at 30, 40, 50% under market value. If you can get a property at 40 or 50% under market value, and I'm talking about real market value, not somebody's perceived idea of what the value really is, because a lot of people will tell you, oh, that property is worth, $500,000 when it's worth $250, because that's what it was worth 3 years ago or 4 years ago. So don't necessarily believe the values that you're told. And even if you do comps, don't necessarily believe that those values are accurate either. I honestly don't know the value of some of my properties simply because the area is so variable. There's so many different comps in the same area that are for identical properties. So how do you really extrapolate from that? What you do is you hold on to those properties and let the market stabilize itself, which will happen over the next probably 3, 4, 5 years. So always have exit strategies that give you multiple options, especially if you're buying for cash. If you buy for cash, a lot of people, and when I say cash, I'm talking about either cash or going out and getting a new loan. Cash and credit, they're both commodities that you have personally that you expend. And once you use them up, they're gone. So you want to make sure that you do it properly if you're going to buy this way. So if you have cash that you're going to invest, or you have a certain amount of loans that you can go out and get, then you want to make sure that the deals that you get have a good exit strategy so that you can do it again. With me, if I'm buying properties, say out of my retirement account, I want to buy properties that I can keep for the long term, but I also want to have a secondary exit strategy in mind where I can go and sell them to investors. And I could take a chunk profit off of selling that property. If I can't get it sold, I'm still going to keep that property for the long term and hold it. You know, I have the belief that I don't sell any properties to investors that I wouldn't personally buy myself. Well, the way I'm doing it right now is I'm buying the properties, doing a little bit of rehab to them, raising the price, selling to an investor, and still getting that investor 15 to 18% return on their investment. If you want to buy one of those properties, let me know. I'll sell you one. But you can do it yourself, and you could probably make 25% return on the same type of properties. You just have to have the infrastructure in place to be able to get find the right property, and they're not always easy to find, as much as you might think that they're everywhere out there. The properties that we're buying, or that I'm buying personally, a lot of them we're buying through the MLS. They're real estate owned. They're foreclosure properties. We buy them the day they come on the market. We usually make an offer, a full-priced offer, the day they come on the market, and they're usually getting 5 or 6 other offers that same day. And we've narrowed it down to certain areas that we're buying into, where we know where it's going to be easy to rent, where we know it's going to be easy to fix up. And so we're very specific about the criteria that we use. And I've got somebody very good who's helping me find those properties, who goes out and looks at them. And then when she finds them, I go out and I confirm, yeah, let's go ahead and make this offer on them. We make the offer. We get them closed. She goes in and has them repaired, you know, manages the property, fills them up. And she makes money that way. I make money on the long-term investment property, or I turn around and sell them to investors and just tack on, you know, 10 grand to the deal. So that they still have a good return on their investment, but I made it worth my while as well. So if you want to buy those kinds of properties from me, I'd be happy to sell them to you. If you want to find them yourself, if you're in my mentor program, I'll be happy to talk to you about different places you can do that, depending on where you're located, that might be geographically desirable to do those kinds of properties with. Because the beauty of, if you're paying cash for property, the beauty of doing it the way I'm doing it is they're very cheap. They're very easy to get into. And they're very easy to sell to other investors, because there's a lot of investors out there who have, you know, $25,000, $35,000, $45,000, $50,000 to invest. But there's a lot fewer investors out there that have $100,000 to invest or $200,000 to invest. And they're still out there, and I'm still finding them. I'm selling multiple of the properties to these people. But if they have to keep those properties, then their return on their investment is going to be much slower. Or much lower, because on a $100,000 property, it's probably going to make $900 a month income. If you buy one of my $45,000 properties that makes $900 a month income, you're going to be doing a lot better off. You're going to have twice as much income for the amount of money that you're investing. So it makes a lot more sense to buy the cheaper property, especially if they're in stable areas and they're being managed by a professional and they're in good condition, and you have good tenants, a good screening process for your tenants. So that means having a good infrastructure of established people that are working in a specific area that know those properties. The other way you can do it is we sell properties that we've already sold on land contract to an end user, and you buy the underlying deed for the property. And you know, you make 15 to 18% on those regularly too. You don't have to have a manager. You don't. You know, all you do is, we have a loan servicing company that they send their payments to, and essentially what you're doing is buying a note. It's a little more complex than that. If you go to my website, stoppayingrенtamerica.com, you can see some of the ones that we're selling. Or you can get in touch with me personally. I'll be happy to talk to you about buying investment properties and what might make the most sense to you. Only call me though if you've got cash to invest. Don't call if you want to get a loan, because loans are so difficult to get now. I don't even like to deal with them these days. But if you've got cash to invest, you know, at least, you know, $40,000 to invest, I'll be happy to sit down, take some time, talk to you about what type of investment might make the most sense for you and what we've got that we can sell, either myself or one of the folks that I work with. So anyway, with all that said, the first, once you find a property that you can buy for cash, you have 2 different strategies here. You can either sell it for cash, but if that doesn't happen, you've always got your other exit strategy of keeping that property for the income. And the only way that that's going to make sense is if the income that comes in is better than you can get through a mutual fund or through a money market or through the other investment utilities that you've got. All right, hope that helps.